Are you stuck trading in a ranging market? Do you know which direction the price will actually go? In this video, I will show you the ultimate ATR trading strategy that made me 102% profit gain. Stick around till the end because I will show you how to get access to our free ebook that will teach you how to trade like a pro. If you follow the steps in this video, you will be able to consistently make money. In this video, I will show you the best way to use the ATR indicator. I will show a trading strategy that is highly effective using the ATR. I will also show you how to use the ATR to set your stop loss due to high volatility. And I will test this strategy to show you the actual win rate and profit gain. Warning: following these steps can make you a lot of money, but nothing in this video is financial advice. Trade at your own risk tolerance. What is the average true range, or ATR indicator? The ATR is a technical indicator commonly used in trading to measure volatility. It was developed by J. Wells Wilder Jr. and introduced in his book, New Concepts in Technical Trading Systems, in 1978. The ATR provides traders with insights into how much an asset's price typically moves within a given time frame. Traders, if you can just take a moment, hit that like button to help boost the YouTube algorithm, I would greatly appreciate it, as these videos take a lot of time and effort. Back to the video. The ATR indicator can be used in multiple ways. It can be used for volatility assessment. A higher ATR indicates that an asset is more volatile and may require wider stop-loss levels. Conversely, a lower ATR suggests less volatility and tighter stop-loss levels. Also, traders use the ATR for position sizing. Traders can adjust their position sizes based on the ATR. For instance, if the ATR is high, a trader may reduce their position size to manage risk. Finally, for trend confirmation, some traders use the ATR to confirm the strength of a trend. An increasing ATR may suggest a strengthening trend, while a decreasing ATR could indicate a weakening trend. However, this doesn't mean that the higher ATR value means we are in an uptrend or downtrend. This just means that we have a strong up or down trend due to high volatility. The ATR can be applied to various timeframes, such as daily, hourly, or even intraday charts, depending on the trader's goals and trading style. In summary, the average true range is a valuable tool for traders to assess and manage volatility, adjust position sizes, and make more informed trading decisions. It provides insights into the typical price range for an asset, helping traders adapt their strategies to different market conditions. Now to use the ATR for trading. I will show you how to take advantage of market volatility to look for breakouts. As I mentioned before, the ATR indicator will tell you when the volatility is increasing. However, this does not mean that the trend is going in the upwards or downwards direction. Market volatility can be high while the price is going up. And it can even be high when the price is going down. So to filter this out, you should use the ATR in combination with an indicator that will tell you the trend direction, such as the 200-period exponential moving average. When candles are above the 200 EMA, we look for increasing ATR value for a potential breakout to the upside. When candles are below the 200 EMA, we look for increasing ATR value for a potential breakout to the downside. Here is an example of a long position. As you see, the candles are above the 200 EMA. Now, we keep an eye out for the ATR value to spike up, signaling high volatility. Then, enter for a long position for a breakout to the upside. Here is an example of a short position. The candles are below the 200 EMA, and now the ATR value spikes up because of high volatility entering the market. Then, we enter for a short position for a breakout to the downside. Next, I'm going to show you how to use the ATR indicator to set your stop loss like a pro. You see, most traders will set their stop loss at a support or resistance level, or at the swing low or swing high, depending on your trading strategy. The problem with this is the candles will barely touch your stop loss, and then it will continue in the direction that was planned. Let's look at this example. Let's say the plan is to enter on this candle and set the stop loss at the previous swing low. As you see, the candle touches the stop loss, which would have resulted in a loss of money, and then it goes in the direction you planned. This happened by barely touching your stop loss. This happens over and over again for many new traders because they fail to take in consideration market volatility. The ATR indicator will tell you how volatile the specific candle is. So one way to avoid getting stopped out too early is by adding the ATR value of the entry candle to your stop loss. Let me show you how to overcome this using a common trading strategy. Let's say we want to use a trading strategy that uses the MACD and 200 EMA. We enter a long position when the candles are above the 200 EMA and the MACD crosses up through the signal line. You see, a new trader will set the stop loss at the previous swing low. However, an experienced trader will set the stop loss at the swing low plus the ATR value of the entry candle. So what you do is you hover over the entry candle, and the ATR indicator will show the ATR value on the left side. In this trade, a new trader would have set the stop loss on Bitcoin at 44,708, but an experienced trader would use the ATR value of 2,282 and subtracted that to the stop loss value, making the actual stop loss 42,426. As you see here, you would have won this trade because of the addition of the ATR indicator, which takes in consideration the market volatility. In this video, I already went over how to use the ATR indicator in combination with the 200-period EMA to find breakout points. I also showed you how to set your stop loss like a pro in combination with the MACD strategy. Next, I will use the MACD and 200 EMA in combination with the ATR indicator to test this strategy 174 times on the Apple stock. Trading Express created a script that will automatically backtest every historical trade across any asset or time frame for this specific strategy. It will even take the ATR value and add it to the planned stop loss to avoid getting stopped out too early. You can refer to one of our previous videos that goes in depth using the MACD indicator. In this video, I will backtest this strategy with the ATR to see the actual win rate and profit gain. You can have access to this indicator script on our website. The link will be in the description below. Once you have access to the script, add it to the chart, and script will allow you to adjust the inputs such as the initial capital size, reward to risk ratio, the amount you want to risk per trade, and if you want to take only long, only short, or both long and short positions. For this backtest, we will be testing Apple on the 30-minute time frame. We will be using a 1.5 reward to risk ratio with an initial capital size of $10,000. We will be risking 2% per trade. Once you input the information, click OK, and the script will automatically backtest all the trades. The script will display a custom dashboard that shows you the number of trades, win rate, profit gain, highest winning streak, and highest losing streak. The script found a total of 174 trades, with a win rate of 51%. This strategy had a highest winning streak of 9 trades in a row and highest losing streak of 5 trades in a row. Therefore, this would have been a successful asset to trade on the 30-minute time frame using this highly effective MACD strategy in combination with the ATR indicator. This indicator by Trading Express back-tested 174 trades within minutes. You can back-test this strategy on any asset and time frame. Furthermore, this indicator will tell you exactly when to enter a trade and exit a trade. Link is in the description below if you want access to this indicator. Regardless of the trading strategy, every trader needs to use proper risk management. As you saw in the back test, we risked 2% per trade, meaning we were willing to lose $200 from our $10,000 initial capital, which means we could have lost 25 consecutive trades and still have a balance of $5,000. The ATR indicator is a great measure of volatility. When volatility is high, you should hold a smaller position size. When volatility is low, a higher position size should be okay. The reason why you want to hold a small position during high volatility is because we do not know which direction the market will go. When volatility is high, price can jump up and down relatively quickly. Therefore, use the ATR indicator to control your position size and manage risk. If you want access to our free ebook, that will teach you how to achieve $1,000 per month consistently day trading or even swing trading. The ebook will show you 2 unique strategies, one for day trading and one for swing trading. It will show you step by step how to use these strategies. The link will be in the description below. Click on the link, follow the steps, and you will have instant access to the ebook. If you carefully follow the information in this video, you can make money in trading consistently. Thanks for sticking around till now. We will have much more valuable content that we will be providing soon. I would greatly appreciate it if you hit the like button, as these videos take a lot of time and effort. Leave a comment below if you want me to test this on another asset or time frame, or with other reward to risk ratios. Subscribe for more future content.